Hello, Face. Let's have a great week, Warriors. Hope everyone had a great weekend. A couple of things I want to cover before I hand it over to Blake. The dollar is trying to weaken. You know, I've been skeptical of this dollar rally. The weak sister is Aussie. And Aussie, I still think could trade down to the 76 level, especially if you have something like this decline from here. Pretty weak response to dollar weakness. I prefer when I'm bearish a dollar that the euro be leading to the upside. That's not the case. You have euro up 29 pips and pound up 60. So, of course, euro pound is still under pressure. So here's your Dixie right here. So basically we held right here on the 4-hour. Maybe it's just an ABC and we still get another wave up in the dollar. I can't get very bearish on the dollar when EG is heavy. Everyone with me on that? When I'm bearish the dollar, I want to see euro leading the way, outperforming cable, rather than what's happening now. Just give me a why if you understand that. Doesn't mean the dollar can't continue to erode, but classically you want to see the euro outperforming cable during a bear move in the dollar. Okay? A couple other things I want to talk about here. The S&Ps have taken out the 61.8 sellers from a week ago last Friday. They're gone. I have some type of wedge line up here coming in around the 27.76 level. What I would do now is wait for candle closes back under 61.8 to know that this may have terminated. And you almost have an identical setup in crude oil as you do in S&Ps. Again, crude oil has taken out the 61.8 level, but to me it still looks like we could still have one of these from here, and if crude rolls over from here, it gives you like a 55 target. So again, here's the 61.8 level. Are we going to stretch to 78.6 first, like maybe the S&Ps? We start closing back under 61.8. This could be a failing rally after this decline. And if you have equality, it's going to take you back under this low towards 56, 55. It would also have a negative impact on stock indexes. One of the strongest groups Friday when we had that rip your face off rally to the bears were oil shares. So keep an eye on that as well. The precious metals didn't need much of an excuse to take off here today. With marginal dollar weakness, you're getting a very strong day in gold. I guess you could say, is this going to be a failing rally? Or are we on our way back up to 1360? Silver, you know, tough call. You know, I'd still like to buy it lower and gold lower. So perhaps this is just a little pause in the dollar. We get one more surge in the dollar to 91.5 or so and stay under 92. That might be the time to move into metals. So basically I'd be keeping an eye on the 61.8 levels in crude as well as S&Ps, and I don't trust this dollar weakness. That's a theme and what I wanted to get across to everyone this morning. So you don't have to agree with me. I just want to make sure that you get it. You know, this is about sharing a perspective and also mentoring at the same time. So now you know that I consider pure bear moves in the dollar to be euro outperforming cable, and pure bull moves in the dollar is when the euro is weaker than cable. So we'll see what kind of week we have. I don't know what's on the calendar this week, but I keep an eye on those 61.8 levels in oil and crude. They look like they're kind of attached at the hip right now. So you may get a market tell in one or the other. I favor that if they start trading back under those 61.8 levels, now that they've taken out those shorts, that there might be something there on the short side. So let's have a great week. You have a lot in here in face. And I guess I need to use new hardware. Is my volume okay, everyone out there? I always advise people to invest in their future performance by having the whole team at your fingertips. You go to any other subscription service and you're not going to get all these different methodologies by some very sharp, talented trading minds that we have on the FACE team. And you also, it's unclear. Okay, thank you, Sunil. Yeah, I had something pop up. Better now? I'm talking right into the microphone. But you want to have this team on your side. And remember, we do have, for people that do not like to be chained to their workstation, we do have a mobile app. So even if you go on vacation, if you're a lady, you could put the whole team in your purse and take us with you and go about enjoying your day at the beach. And if anything significant happens, like support resistance breaches or patterns in play, you're going to be notified with a push alert. So I know you can only bring on one carry-on on the airplane, but all of us fit. And as a member, you're going to be able to see Amanda trade in the private chat room. She's a pro. And, there are a lot of people in there sharing ideas. It's a great place to learn. It's always been a philosophy of mine that to surround yourself with traders better than you. That's what I did when I came to FACE. And you have 95 people. You have 95 people in here. Yes, Coach did say I wasn't buying this dollar weakness. Oh, buying this dollar rally. Okay. Yeah, see, and we have fun too. Sometimes you take trading, we all do, we make it life or death. And really it's just a business, it's trading. I teach people where you want to get is not too high on your winning trades so that you don't feel dejected, deflated, depressed when you're wrong. Where you want to get to is it's just another trade. And you have 95 pros in here that have learned to do that. So with that being said, I'd like to turn it over to Blake. He always crystallizes in my views, especially when things are foggy for me on a Monday morning. How are you, buddy? And what are you thinking here of the dollar?
Good. Hold on one second.
Okay, you got it.
I'm about ready to sneeze, so
oh, God bless you.
Hold on.
Will it be a double? Every time I walk into the sun, I sneeze. Go outside and I see the sun.
No, I avoided it. That's good. It's that time of year where
yeah.
it's that time of year. So
orange blossoms. I lived in Arizona and Phoenix in the spring, and the smell of the orange blossoms like perfume outside.
Oh, it is.
You have allergies.
Well, first of all, the smell of orange blossoms is for us. I want to say it is it is in the fall. That's
okay.
when we get them in the fall. So because our oranges actually grow December, January. So we really get all of our.
Maybe it was jasmine.
Maybe, but everything grows. I mean, we just had some rain, and which is not common here, but it's our, we're changing over from spring to summer because we only have 2
days of spring.
No, well, we have two different seasons. That's pretty much it. We go spring, summer, spring. Anyway, this is the time of year where the changeover comes, and it's a little tougher for me. And once everything's once it's 100 degrees, then it all dies off. So it's good. But we have it's actually going to be a big week this week, Dale, and really the big week comes because of we have Fed Chairman Powell is going to be his first his first testimony. He's got the 2-day testimony first with the House and the Senate, or is it the other way around? not
Yeah,
just
I
your
think
rock.
it used to be called Humphrey Hawkins Day. They don't call it that anymore.
Nah, yeah, you're right. It's still referenced as the Humphrey Hawkins testimony from the old Greenspan days, but it regardless, it's going to be an important testimony. It's his first, so a lot of people are wondering if he's going to come out swinging, if he's going to be a little bit more hawkish. It's going to be interesting. I look at the thing about the euro dollar. I've got to point out, and I know I did in the week ahead video. I don't know if you had an opportunity to see that. And
Yeah,
by the way, you did.
Yeah.
The week ahead video, it was a little tough this week because it was like, what do I, what am
What
I?
happened with that already?
Well, no, it was kind of, I didn't have a whole lot to talk about other than, hey, we have an upcoming meeting, and then we have these moves in bonds, and stocks are still pretty well bid, and I'm kind of more sitting on the sidelines waiting for the possibility of dollar strength. Now, one of the things that I want to point out about the euro dollar, though, is that the euro dollar is still not getting too much of a bid. I mean, it's still really trading quite heavy after hitting that false breakout. And when you have a false breakout, and I know I've said this, I must sound like a broken record at times, but false breakouts usually lead to breakdowns, or false breakdowns usually lead to breakouts. You could say vice versa, but right now I'm looking at this false breakout as we're eventually going to break down. I still believe that. I don't think there's definitely nothing regarding the price action that's suggesting otherwise. I mean, the euro dollar is trading heavy.
Yeah,
it is, and now
underperforming cable, so that to me is a kind of a market tell when you have cable up 60 and euro up 25.
It is, and speaking of the cable, the pound hit really key resistance today. First thing I did as soon as I got up in the chat room was I sold the pound at 140.49, I think. Oh, here it's 46. I actually sold it at 46, and then I closed it out at 41. Or no, excuse me. Then I closed it out at 32. Then I reshorted the pound again. And so I'm trading the pound to the short side because I know we're right up against resistance. So, and I know the euro's trading heavy. All right. And so, I shorted the pound, and I have not sold the Kiwi or the Aussie, which probably would have been a better trade actually. But you look at the Kiwi dollar, and there's still a big looming double top. And I'll tell you, man, if this Kiwi dollar breaks below, let's just call it 72 cents, which it's a little bit lower than that, but Kiwi dollar breaks below 72 cents, this thing's gonna just take a nosedive. In my opinion, the dollar Canadian, if you were, again, if you're using ForexAnalytix, the dollar Canadian, you can see updated here that we were right at support.
Very well on Friday before the info. I listened to part of the session on Friday, so you had it diagnosed pretty good, buddy.
It was one of those that I'm trying to think how I traded it on Friday.
At 1.27 near the high you talked about, and failed.
Yeah, and actually what I did I actually picked up a piece. I actually picked up a piece ahead of the data, just a small, right? I picked up a small piece. I'm like, this thing's trading pretty bullish, and I was wrong because it dipped, but I bought it again at 50. I added to it, and it came all the way back, and I sold it, and I miraculously made money. So it's one of those, like I bought a little piece here, I bought a little piece here, and then I sold it here and made a little bit of money, and I was like, wow, I got really lucky. It was lucky because the way it was trading is that it was trading actually pretty pretty bullishly, and we were above this trend line. I'm like, you know what? If it breaks out, I'm not going to get an opportunity to buy it. I'm gonna be left in the dust. So I'm gonna go ahead and just pick up it was only a third size, so I really wasn't worried about it as it went down. So I actually ended up making money, and I was very surprised I did. And I kind of walked away from that saying, you know what? I'm going on the golf course today. I somehow made money. I'm gonna chalk it up to being lucky, and just hold on really fast. Hold on. Okay, I just sold my. I just exited my Swedish krona. Sorry. So anyway, the one thing I want to point out about the Canadian and this morning is that we were trading at this 126.40. We did not take out lows from Friday, and we're 30 pips higher now. You see the U.S. dollar Canadian managed to hold Friday's lows after the weak CPI, which is surprising given the weakness of the U.S. dollar across the board. As long as 126.20 holds, the pair could be heading back to 127. That was earlier this morning, and you can see the dollar Canadian's getting, quite a lift now at this point. You look at the dollar Canadian, which I don't own anymore, but like for example, Joe, who is in our chat room, she's in Canada. She trades a Canadian probably more aggressively and more often than anybody else in our chat room. I think she queued off that analysis, and she's like, I'm closing my short from Friday. She closed her short right, around the 40 level as well, which is, that's how you use ForexAnalytix. It doesn't mean you have to look at ForexAnalytix and go, oh, well, what kind of pattern and play does so-and-so have? I'm only going to trade those. No, you use the analysis to cue off of what you want to do and how you're going to trade the markets. I think that's, it's important to understand that. Anyway, so there's the Canadian, the Swissy. Actually, the Swissy is holding up pretty well. I guess it's probably holding up relatively well due to the lack of risk aversion. If the market becomes a little bit more risk averse, I think the Swiss comes more to demand. But stocks look pretty. They look all right now. And matter of fact, I'm going to talk about the stock market here momentarily. But let's finish up with some of these others. The Norwegian krona is kind of sideways. I actually bought the U.S. dollar Swedish krona this morning, just about an hour ago, maybe. Somewhere around here. I just sold it this morning. One thing about the U.S. dollar Swedish krona is this currency pair is holding up really well. We may be stalling at the 50% retracement, but you want to talk about outperforming your peers. The U.S. dollar Swedish krona is outperforming other dollar pairs right now. And this particular currency pair, like the U.S. dollar Norwegian krona, is the same way. We had a false breakdown here, and if you didn't notice that from last month, we had a false breakdown, and I take that as a cue to be long. Now, the one issue that we have with the U.S. dollar Swedish krona right now is we might have an AB equals C, D, which might take us just a little bit higher. So I'm as I did this morning, I just scalped it to the long side, not like I'm sitting in the U.S. dollar Swedish krona for 3 weeks at a time. I'm just kind of scalping it to the long side, but it is performing relatively well. Let's see. Here's the U.S. dollar Mexican peso, still maintaining inside of this channel. Very sloppy trading. But let's talk a little bit about the S&P. So I've been looking at the S&P as a potential, rally to this maybe like 2,800 level or so before I look for further risk off. Now, that's important, not necessarily because I'm going to short the stock market here. It's because I'm going to use that to cue off of, yen strength, possible dollar strength. But as long as the stock market is bid you've got to take that into account with what you're doing. You know, I'm a little nervous about trying to play yen strength right now, even though I'm very bearish the dollar yen. And matter of fact, I'm very bearish every yen pair. I'm a little skeptical about trading the yen on the long side while the S&P is still very well bid. But if you look at like the dollar yen's still trading pretty heavy. You may have the euro yen slightly up, but still, you know, this pivoted off of 618, by the way. It's still trading heavy despite the you know, probably or despite the stock market strength that we're seeing this morning. The pound yen's up a little bit, you know, the Aussie yen's up a little bit, the Kiwi yen's up a little bit, but overall, I mean, these yen pairs are still, you know, trading relatively heavy. And like I said, you got to take that into account when you're trading the FX market. You got to look at the S&P and go, okay, well, you know, how much higher can we go? I still think we could trade towards 2,800. You look at the Dow, you know, to really complete this Gartley, you know, we're still looking at maybe, you know, 25.8, somewhere around here. So, and actually, if you do this, 161% extension comes right in, right there, from this low and this high. So I mean, we realistically, here. Let me delete some of these blue lines. I'll just kind of draw them out for you. What is that? I don't know what that is, but I'm gonna remove it. Oh crap! I didn't want to remove that. Whatever I just took out, I didn't want to take out. So I would think
400 points left in the Dow.
Yeah, I mean, I would think if I had to assume where we're going, you know, it's probably somewhere up there. We may get up there, we may not. You know, maybe we turn around today. Maybe the market just, you know, turns lower right now. Who knows? But that's what I'm thinking. And I'd like to see stocks rally. You know, it is Mutual Fund Monday. Don't ever forget, Mutual Fund Monday is a tough day to be short. You know, as soon as the market opens today, they're probably going to jam the stock market up. And then, you know, then from there, over the course of the next, you know, 24, 48 hours, we might see a stall somewhere up 300 to 500 points higher in the Dow. And then that would trigger me to start thinking, okay, we might get some risk off. How am I going to play that in the FX market? Because for me, 99% of what I do is in the FX market, for me personally. So I'll look for big pivot areas in the stock market, for example, and say, okay, well, how does that translate to FX? And in that case would be, well, if the Dow makes it to, let's say, 25.8 or 26,000, then at that point in time, I'm going to start looking for yen longs and maybe some dollar strength, and, you know, maybe a euro yen short or something like that. And you pointed it out earlier. I'm surprised that gold is as strong as it is, silver is as strong as it is, and, you know, maybe those stay bid, you know, fairly well bid as we go into those higher levels in the stock market. And then, you know, then what happens up there? And that's you know, do we get you know, risk on, risk off, you know, or excuse me, risk off, and then, you know, does that translate into gold strength and dollar strength at the same time? I don't know, but, you know, that's kind of what I'm thinking. Now I'm going to let Steve talk about the bond market, because him and Stelios, they posted a blog about the bond market, but I think this plays a part into this conversation, and you got to start taking a look at what's happening with bonds, what's happening with yields,
Blake,
and what's happening with boons.
Sorry to interrupt, mate. I need to do a fast restart. Okay.
Fast restart of his computer.
Of my. Yeah, because I can't seem even to load TradingView, so I won't be able to show anything.
Okay, we'll see in a little bit.
Yeah, if you
Okay.
have to go, Blake, I could, cover till Steve is back.
No, I got a few minutes.
All right.
Yeah, and Steve's been he's been haggling with his computer as of late, with his video card. So I don't, he probably is just something he's dealing with, unfortunately.
I
And
think
for those of you,
I think we were ahead of the curve for a bear market rally in bonds. I think most of us were talking about that last week before it happened. I mean, that's why they wrote. Steve and Stell wrote the blog. I mean, we don't write blogs usually way after the fact, and that's something for the community to keep in mind. We're writing a blog because we think there's something fairly imminent about to happen in the market.
yeah, I hate weatherman analysis. I hate it. It's like my biggest pet peeve in the world is if you recap and tell me what happened, I'm like, I so will ignore you. Like,
Yeah.
Well, the dollar
like
rallied because of this, that, the other. Yeah, like a reporter. It's you're doing weatherman analysis. Like, well, it's cloudy and rainy outside. Well, no shit. I just went outside and it's cloudy and rainy. I know that.
Yeah, George Carlin said, my forecast for tonight is dark, turning lighter in the morning.
Yeah. Like, I don't want to know that. We try to, you're right. When we're blogging something, it's like, hey, this is, pay attention to this. It's a setup or it might have some future ramifications on the market. And that's why we're not blogging all the time. Like people that blog all the time is because they're blogging and they're recapping what had happened. It's easy to do that. It's simple. I want to show people what the forest looks like behind the trees. You know what I mean? I'm not going to tell you that the tree is green and it's got bark. No, I want to show you. I want to explain to you what's behind the trees. And so that's why we don't blog all that often. But when we blog, they're usually pretty important topics of discussion because we're trying to give you a heads up on something, and that's what it is. But anyway, yeah. So Steve was talking about the bond market, and so was Stelios, and why we could see a potential bear market rally. And speaking of which, we're seeing a little bit of selling in equity. I see. I sit here and I look at the stock market. I really hope we're going to, like in this case, I hope the S&P is going to 2,800. We may not. I mean, who knows? I mean, we could really, if you look at like the S&P right where we're at, Dave, I just called you Dave. Sorry, it's early. It's Monday. I can't even believe I just called you Dave.
My Hebrew name, Doug.
Is that your Hebrew name? Yeah, maybe Dale, that we had this. Maybe we're just finding resistance right at, resistance.
Yeah, they shook out the 61.8 traders. They got their stops today.
Yeah, yeah, it's possible.
Yeah, we'll see.
It truly is possible. But anyway, actually, I bet Stelios is probably here too. I wonder if Stelios is around. Let's see. Oh, maybe not. Yeah, sometimes he's here, sometimes he's not. But anyway, I'm wondering if we've stopped here. I'm not willing to step in front of the stock market, meaning, I'm not ready to start trading as if we're seeing risk off, not yet, because I still think there's a possibility that we get up towards 2,800. But I think I'd have to see a move. I think we'd have to see a move all the way back here below, Friday's lows right through here. No, I guess Friday's lows would be over here. We'd have to see a break back below like some of this support here before I got excited about the stock market actually reversing. But who knows, Dale? I mean, maybe we do head down there. I don't know. It's hard to gauge right now, but
I would say the likelihood, though, Blake, of Paul being more hawkish is a higher probability now than if we had been in the middle of the panic a few weeks ago. So, he has a little more room to sound tough than he would have,
sure,
during the crash, the panic. So, He may sound like a tough guy now that the market's recovered.
Yeah, I mean that's a great observation, and I know that they're not supposed to take into account what the market's doing versus you know, for monetary policy, but I don't care what anybody says. Of course they're looking at, you know, what's happening in the stock market, and of course they're taking that into account. They're not going to go into being a full-fledged hawk if the market's in panic mode. You know what I mean?
Yeah.
No, it's just not going to happen. So I don't foresee that. I actually would agree with you in that respect, that if we were trading below these lows and the market looked, you know, like, you know, we just had sold off 15%, he's not going to come out and be extremely hawkish. But yeah, I mean, you know, with the recent stock market recovery off the lows, he's probably still thinking, or the Fed is thinking, okay, you know, the markets are still pretty tame, volatility is low. We don't have to worry about, you know, panic-stricken markets.
Because they want that insurance, so the market's giving them a chance to keep building up, taking rates up as long as it doesn't fall apart, to give them insurance.
Sure,
So
absolutely.
They're going to take advantage of every window they have this year to do it.
Now let's take before Steve gets here, and he should be here any moment because he's resetting his router. He just sent me a message. The one thing about the dollar, for me, I'm really most concerned right here with this dotted trend line, basically. As long as we are below that dotted trend line, it's hard to be extremely bullish the dollar. But we should also note that if you look at the dollar, we're also at a big 618 retracement, okay, from the 2014 lows. Matter of fact, I think we're in between fibs here, but I'm going to draw it out anyway, just because I think we should. I think it's in between fibs from the 2011 lows. You know, actually that's a 50% retracement.
Yeah, there was confluence there all over.
Yeah, there is, and that the 50% retracement as well. So, you know, there's a lot of reasons why the dollar could bounce where we're at technically, and this is what has made me very skeptical about being, you know, on the short side of the dollar. You know, the last couple of weeks we've been down here. So anyway. Steve, it sounds like Steve is still having a very difficult time with his internet. His internet may actually be down right now, so that seems like Steve is having an issue. You know, the problem with Steve and Stelios is they live in a third world country, so you know that's the issue, right?
Yeah.
Just kidding. Wait till Stelios jumps in and he gets to give me an earful. No, but you know, we've all had internet issues. Do you remember this, Dale? Was it when we were? No, it wasn't when we were together. So I was sitting here one day and you know, working, trading, and a friend of my son's, his mom, here to pick up her son, and she backed right into my cable box, knocked out cable for my entire street.
Oh my God. Yeah,
I was like, that's great. It literally took like 2 days to be fixed. So anyway, it's one of those things. So it does happen. You know, so if it doesn't matter where you're at, whether you're in Athens or it seems like your internet's always pretty darn good there, Dale.
Yeah.
All right.
Well, Frontier.
Well, I'm gonna skip ahead then. I'm gonna talk a little bit about the bond market. So here's the 10-year, and this is kind of the what Stelios and Steve were talking about from a technical point of view. We're seeing the bond market bounce. Now that means that yields are coming down. Now you could take that a couple of different ways. You can go, oh wow, stocks are going to like this because yields are coming down. But you know, because we're coming off that 3% level in yields, or close to. We never quite got there, but I mean, you look at the 10-year, we were up at 290, 295. So this fall that you're seeing in yields might be giving the stock market a little tailwind, a little bit of relief, but at the same time, you got to ask yourself, why is the bond market rallying from here? And you know, if it continues to rally, is it doing it for a reason? And so that is something that I think that if the market, you know, we were talking about the S&P, if the S&P goes risk off, you know, the bond market's going to go bid again. And if the bond market goes bid like this, like you're seeing right here, that means yields are coming down. If yields are coming down, that means that these yen pairs, whether you're talking about the dollar yen, euro yen, pound yen, doesn't matter, they're going to come back under pressure. And that to me, you know, it's kind of what I'm queuing off of versus, you know, being completely reliant on what's happening in stocks. So, and it sounds like Steve has made it back. I don't know if he jumped on via a different computer. So, Steve, are you there?
Hey, Blake.
Hey, so how's your internet working over there?
I think there is some local problem, and when I say local, probably it's not so localized. I've seen it happen before. It's very rare. My internet is working, but I don't have access to all IP addresses. So, for example, I can be on the webinar, but I cannot. My Skype is working, my Twitter is working, but for example, I cannot access several pages. So TradingView is inaccessible to me. Even our own site is inaccessible to me. I think it has to do with specific IP addresses being down at the moment here locally. So, yeah. I just tried my MacBook to verify, you know, 100% that doesn't have to do with my computer, which I didn't think it has. But yeah, I see the same thing here, unfortunately.
Wow. So you can't really display charts.
No, I can't. I don't have access.
That's interesting. I was explaining it, you know, to Dale and the rest of the viewers. If you didn't live in a third world country, this wouldn't really be an issue, but apparently it is for you. So yeah, I'm just giving you a hard time. I'm giving you a hard time. So let's talk a little bit about the bond market, and why don't you explain? And I've got the charts up. So why don't you explain your thoughts on the 10-year bond market and what is happening in the bond market versus what you and Stelios were writing on the blog?
We think that there is a good potential for the bonds to resume their move lower and yields to keep on rising, but we do see that there is a decently big risk for short-term reversals. We saw the Bund was actually the canary in the coal mine because the Bund it was the first one to actually form a descending wedge, and then it broke above it, and it also broke above the breakdown level because we had a very important breakdown area, which was, if I remember right, roughly the 159.30 area.
Yeah, you can see it right here on my screen.
Yeah, exactly. So you know, we broke below that area, but then instead of accelerating lower, we formed a descending wedge, and after forming the descending wedge, we actually broke above it, and Thursday, Friday especially, we accelerated. So the fact that we closed above 159.30 is quite an important development, and you know, this week is going to be quite important. The treasuries seem to be following suit with some kind of a delay, but I think that you know, we should be paying attention to these developments because, as we know, as it happens with the dollar as well, the market is also quite bearish bonds, and you know, if we get a squeeze from here, the market has the potential of actually producing you know, some decent rallies higher to at least retrace to the beginning of the wedge, get some weak shorts out of the market before then resuming lower. Also,
so the question is, well, what does that do to the dollar? Because, typically when the bond market rallies, yields come down, and when yields come down, the dollar is under a little bit of pressure. Now, we haven't seen that be the case as of late. We've seen bonds move down, yields go up, and the dollar go down. So the question is, will we see dollar?
It depends. This is a chain. This is a chain of events, and I'll explain exactly what I mean. So we have a chain of three factors here, right? Factor number one: what bonds do doesn't matter in isolation. Two, the DXY, because usually when we're talking about the dollar, we are having a look at the DXY, is 58% in the euro. Now, let's connect these dots. This means the following. US Treasuries can break out of their descending wedge as well as they have done and accelerate higher. But if at the same time the bonds keep overperforming them, right, that means that we shouldn't look at it in isolation, because the Euro USD can keep on underperforming for a period of time, and a Euro USD underperforming can mean that the DXY can remain decently to very well bid. So the question is not what US Treasuries are going to do, but what US Treasuries are going to do in comparison to other bonds and bond yields in major countries, right, Blake?
Yeah, that's true. That's true.
Yeah. So if we see a generalized environment that bonds provide, safe haven bonds, etc., provide some type of rallies, we should then start seeing what they do among them.
So do you think that, right now, and this is something that I was talking about while you were restarting your computer, one of the fears of the stock market has been higher yields, and we had the 10-year yield that it was approaching 3. We got to 2.94-95%. Obviously, yields have come down as the bond market is shown a little bit of life. Does the stock market like the fact that yields are coming down, or are yields coming down because bonds are rallying? Maybe there's a reason why why is the bond market rallying? Is it all technical, or is it?
I think it's the Fed, Blake. Before we saw the crash, the Fed sold 20 billion of treasuries, and then we had the crash. And in the period after the 4 days of the crash until today, instead of the treasury being a bond, a net seller, as it's supposed to be doing, since they're supposed to be winding down their balance sheet, they've been net buyers. So I think that in essence, they panicked by what happened, and they reversed course, for the time being, until they see the market stabilize. I was seeing some data that, some great guy I follow was posting about that. So I think that there is a very good reason behind that, right? Now the question is, does that mean that the market cannot get in jitters again and sell off despite bonds, rebounding somewhat? Depends, because when the market realizes that the Fed's plan probably is not working out properly, because as it seems, just a little bit afterwards they decided to reduce the balance sheet. We saw what happened, and everybody now is blaming the XIV for imploding, etc. But the question is, what was the catalyst? What was the initial reason that all that happened? And the fact is, because the fact that this market was rallying due to easy money and quantitative easing and monetary easing in general for so long did matter. And now the fact that the Fed is trying to be more hawkish and to tighten monetary policy does and will matter. That's exactly what the problem is here. And that doesn't seem that it can go away easily, right? I mean, the Fed is already devoted, theoretically speaking, to tightening. and the market doesn't seem to be able to swallow this pill very easily.
Yeah, and so how's the Fed going to get out of this pickle then?
That's why they paid as much as they do. I have no idea. I have no idea. Personally, I believe that this is the third consecutive time that the Fed does the same mistake. Tries to help the economy recover from a recession, recover faster, and than what the market on itself would do by balancing out instabilities, etc. And the end result has been that this artificial recovery is actually very brittle, right? And
right.
Yes, Elio?
Hi guys. Sorry, I just wanted to interrupt if I can, just for a second.
Oh, please.
What I was going to say was pretty much in line with what you're saying, Steve, is that we are having a decent recovery in the US. They're hiking, they're unwinding the balance sheet, they're hiking rates. What's the problem with letting 10-year rates go to 3% or 4% or 4.5%? Historically speaking, it's not, it was never an issue. Obviously, you don't want it to go from 1.5% to 3% within 6 months, because then it's a shock to the system. But I think what they're trying to do is they're trying to engineer a smooth transition from ultra low, 1.5% 10-year rates. I mean, that's unheard of. That's ridiculous. So they want to go from such cheap money to the old-fashioned, economic conditions and 5% 10-year rates. Why not? 7% 30-year rates. It's not unheard of. In fact, it used to be the norm. So
it used to be the norm, Stelio, but they're going to implode the deficits. The deficits are, as you very well know,
yes.
with this kind of debt burdens we have around the globe, and US is a prime
Yes.
example of that. Are going to skyrocket, and that's going to, this is in essence, this is a self-fulfilling prophecy, because yields going up means that deficits are going to skyrocket because the debt has increased substantially. I mean, what was it before Obama took over? Was it 9 trillion, 8 trillion? What was it? And now we are above 20.
Above 20. And interest payments are going up on the debt and all that. And that
exactly,
at the end of the day, effectively, what is it going to do? It's going to weaken the currency.
Exactly. And what does weakening the currency do? Bring inflation. And what does inflation? What does inflation imply for monetary policy?
Yeah.
Stagflation in this environment, right? Because you get inflation coming through dollar weakness, and then the Fed has a huge problem, because they need to choose which of the mandates they need to follow, because you get inflation coming through the system with a dollar weakening. But
doesn't stagflation bring, isn't it but in order to have stagflation, don't we have to have higher unemployment, weaker economic conditions?
Exactly. That's what's first going to happen, and that's how we're going to end up liking the next recession to stagflation, because the dollar crisis, the fact that for the Fed it's very hard to keep on being hawkish, because if they keep on being hawkish, the deficits will balloon, and when the deficits actually start ballooning, then the market is definitely going to start dumping dollars, with much more force than we've seen already. Weakening dollar is going to create several issues. Obviously, it's going to be also the beginning of the next recession, and the question is, what's happened if during the next recession, due to dollar being dumped, we also have inflation, which is quite likely. It means that the Fed is going to have to choose either between being very loose in monetary policy to help the economy recover, which means that inflation is going to become much worse than it is, or fight inflation, which means that if they try to fight inflation with an economy that is doing barely okay, but with deficits going up, etc., that means that then they're going to kill the economy. So that's why I think that during the next US recession, the possibility of stagflation, which is something that we haven't seen lately happen, is quite a high probability.
The other thing we're going to see, obviously, with the dollar dumping, if that happens, is that the exports are going to look much more attractive. So that's going to be a little bit of a balance, which will help the economy. But overall, it's like you say, Steve and Blake, it's a very difficult balance, and they have to actually choose what they want to do. So what's their mandate? Their mandate is for inflation, right? The primary
inflation,
mandate.
Inflation and employment. These are the two mandates of the Fed. Yeah.
So as long as employment is at unemployment is near record lows. It's forget about the quality of employment, which we've talked about, which is deteriorating a little bit. But unemployment
globally,
is low.
to be honest.
Yes. So, but unemployment is low. So they have the ability to concentrate on inflation a little bit more before unemployment becomes a problem. But I don't know what I would do if I was in the Fed. It's a very tough job that Janet Yellen has left now.
She did really. She left a real big storm. Hey, Kays, can we shift the conversation really quick, because Abdul asked about the euro yen and the pound yen. So I want to just give a quick overview of the euro yen and the pound yen. One of the things about the euro yen that there's actually a lot of developments here. If you look at this chart, first and foremost, we had the false breakout, which led to the breakdown. We stalled on two fib levels previously, right here at 161% extension, 127% extension, right there. But we ended up breaking it, came right back. We came down a little bit lower to the 618, which it's an important development, because that 618 is right at the 200-day moving average. Now, you could argue and say, as long as we stay above those lows on Friday, which is basically 131, the risk is for a bounce. But I'm going to take the other side of that. I'm going to tell you, if we break through 131, the wheels are probably going to fall off the bus, and I would probably err on the side of being aggressively short should we break the 200-day moving average. I think that this is offering us support right now, but I'm viewing it more as that's just near-term support before an eventual breakdown. So
I agree with you, Blake. Although this is triple confluence of supports, because if you see back, I also had this zone marked as horizontal support. As you see, this is an area that rejected price action to the upside a couple of times, and after we broke above it, it has acted as support multiple times as well. So it's the 200 DMA, it's horizontal support, and it's a 61.8. So a critical zone for the trend.
Critical, and so you could, again, Abdul, you can say, well, I'm gonna buy it, and as long as it stays above 131, I'm just gonna be on the long side. You can do that. I'm looking at it as, we might bounce here, but I've been more focused on the euro yen on the short side over the last couple of weeks, and I will continue to do so. So any type of bounce, I'm probably looking to sell into strength, and that's. But you can make money in either direction. It doesn't matter. If you might think I'm going to be on the long side, and I'm probably only thinking, hey, I'm going to be on the short side. I just don't want to be short right at this very moment in time. But I do believe, I do believe that the 200-day moving average, we give that away, and it's all over. Pound yen, still struggling. We remember we came out of it an ascending wedge. There's also you can look at it this way too. We've got a lot of support through here too, like longer term support right through here. This is one of those other situations that, as long as we're above 148, I wouldn't, be too bearish, but at the same time, if we break through 148, it's going to get ugly. And so I'd rather play it on the short side, thinking for an eventual breakdown, but we could still bounce here, especially with stocks as well bid as they are right at this very moment in time. The chances of like a pound yen bounce or a euro yen bounce, I think is still pretty valid. Also, Frederick asked about palladium. I don't even know what the symbol is for palladium. I don't even look at it.
XPD USD, Blake.
XPD USD, or okay,
USD.
right here. All right. Look, I'm going to give you very fresh analysis since this is not something that I normally cover. 200-day moving average looks like that's supported as we were coming to it. This recovery's already been, you know, we're a week and a half into this recovery, so I would be thinking that we're going to start finding resistance soon, and we're right at the 618 previous support. So yeah, this is, I'd probably be thinking while we're below 1085 ish, I'd be a little, if I was long, you know, if I had played it on the long side, I'd probably be, you know, starting to be a little bit careful here. You know, if I was thinking about,
it looks very similar with the S&P, doesn't it? Just look at the, I mean,
it does, yeah, it does actually, yeah.
It's quite a risk on metal.
Yeah, I don't know if it if that's by design, but boy, it does, doesn't it?
You see?
Yeah, it looks.
I trade it quite often.
Oh, okay. All right. Well, then there you go. And so maybe it's what you say, Steve. It's a risk on metal. Oh my God, the pound just took I was short too. Oh, I just closed out my short. It just took an absolute nosedive. I've been short twice this morning. Oh. And I'm a wussy.
I don't even have my chart side.
Oh, you can look at it right here. It's on my screen. Such a pansy. Anyway, Dale, do we not have an interview this morning?
Well, he says he's on his way to a place and he'll try to get on and stall for him, but who knows?
Okay. Well, hey, Stelios, are you here?
Yes, I am here. Yes.
Okay. Can you take over for the next, 5 to 10 minutes if in case the person does not come? Steve can't get his charts running because he's having a little bit of an internet issue in his location.
Yeah. Okay. I think I have a similar issue because we have the same internet provider, but I think my machine is in a better state.
Oh, so, do you have can you see your charts?
Yeah, I can see my charts. Yeah.
Oh, well then you are. Okay, sounds good. Well, I'm gonna pass it over to you guys. I have to get ready for my trading day right now.
Okay,
so
Blake, have a nice day, mate.
Thank you, and good luck everybody, and good luck Steve with your internet. And
I can't do much. I'm just gonna call my provider. I think they have a generalized issue, so yeah, I think it's gonna come back eventually.
Okay. God is you calling God? He's your provider.
Thanks, guys.
What's his phone number? Good hunting, Blake.
Bye, Blake.
Hi, Stel. I see your charts up here. You're looking at the Dixie.
Yeah, my usual charts that I look at.
You have a little roadmap here.
Yeah. I mean, this is a chart I always look at first thing when I get in. It's a monthly chart, so it's not changing that much. But I still think that the dollar will probably see a bounce, probably at the March FOMC, where they're widely expected to hike. And I think that the market is now, hold on, we can see the Fed Fund futures.
I've noticed a lot of people have longer term 84 targets like you just had.
Yeah.
So, you're showing like an 82, bounce to 92, and then a pretty good sell-off, 84, 61.8 back of the whole dollar rally.
Yes, I think that's going to happen for a few reasons. We're still quite bearish in terms of sentiment and positioning. I think it's still quite on the bearish side, and the market is now pricing. Let's see. So February 58, March is at 50s, and that's on the 21st of March. So pretty much 20 basis points priced in for March, and then January is 80. So 60 basis points. So it's about 2 and a bit hikes priced into this year in terms of hikes. So I think that the Fed will probably come in and surprise on the hawkish side because, let's face it, inflation is rising. PPI has been going up, and I think we're going to start seeing this in the actual CPI measurements as well. So I have a feeling that they're going to come in a little bit more hawkish than the market's expecting. the dollar will rally. The fact that we're a little bit trading short and the sentiment is still negative will probably exacerbate this move, take it to around 92, 93. I've seen a few people thinking that it's going to bounce towards 95 or maybe 96. You know, there's a trend line there, which, you know, might be the case. But bottom line is, I think there will be a rally, and then I think we're going to just continue lower for many reasons we've talked about, and the deficits, all that. You know, the Fed is a little bit trapped, as we've said, and they're hiking. And if they continue to hike into an economy which is not, you know, it's doing okay, but if they keep hiking, we're now going to start seeing the effects of all the previous hikes as well coming into the market and the economy. So I have a feeling that this is the route we're going to see. Obviously, I've been wrong many times in the past, but this is what I think will happen. So that's my Dixie view, which is the first chart I look at every day.
Okay.
And I still think that's going to...
I had a question for Steve, even though he's not Greg, but I'm sure he knows the answer. And it's in regard, Steve, to the S&Ps that, you know, the first break. Are you still here, Steve?
I am.
Okay. The first break was like kind of like a mini panic crash, and we've had this recovery. And I wanted to ask you about the rule of alternation. And if the S&Ps say this is we're eventually going to get a C wave, the character of the decline could be different than the first one. Everyone's expecting it to be, you know, a quick flush. Could it be because of the rule of alternation that it's a different type? The character of the decline will be different from A.
Yeah, absolutely. It can be. It can be more. First of all, we can have different types of corrective patterns, right? I mean, we can have. Yeah, we can exactly. We can have a corrective pattern that doesn't even imply a push to new lows from the lows we saw a couple of weeks ago, right? So that's
right.
That's one issue. There is a chance that we're going to see a new low. There is a chance that we're going to get some type of a correction that more or less will keep us range bound between the highs and the lows in what can be erratic or choppy price action, right? What is more or less certain in my mind, and I said it since the very beginning of the sell-off, is that, you know, even if we're headed to new highs, which is a possibility, I don't think that we're going to see new highs for, you know, several weeks to come. So I think the market, despite showing strength during the past several days, I don't think that this strength can be sustained long enough for the market to straightforward push to new highs. I think that the market is going to find, you know, much resistance anywhere between here and the 78.6, which is roughly at 2800, 2805, if I remember, something like that. Okay. And we should at least see, you know, some more weakness coming from around there.
Okay. Actually, we have someone volunteering to do the interview here. Ron, I have to give Nicholas a chance to get here for another 5 minutes or so, but if you contact me on Twitter, I'd be happy to schedule you for one. We'd love to have FACE members come on and be interviewed.
Yeah, absolutely.
I appreciate it. So you could either get a hold of me on Twitter or at ForexAnalytix, and we'll set up a for sure date for you. And that goes for anyone else. You know, there's Dan Norberg. Dan's a great trader. Anyone that's interested in sharing their work with FACE, just get a hold of me, and I normally schedule a couple of months in advance. So, you know, I've had people say, oh, that's right, we already have one scheduled. That's right, Ron, we already have one scheduled. So keep that in mind. You know, people have said to me, Dale, I don't even know if I'm going to be alive by then. But time flies, and, you know, before you know it, your day is here. So I'm going to give Nick a few more minutes, and if not, I think we'll probably just call it a session. What do you guys think?
Yeah, absolutely. Absolutely.
Okay. because I mean, people have 2 months to prepare to be here on time for it. I know stuff comes up, but you know, I don't know how long he wants me to or wants us to wait for him. So let's see. I'd say that we waited long enough. How about you guys?
Yeah.
Okay.
Absolutely.
All right. So
Up to you,
unless there's something else that you guys have to add, I guess we could call it a day and meet up in the chat room and, you know, cover what's happening here today. And tomorrow we'll have a full session and hopefully a guest that shows up.
Okay, that sounds good.
That good, guys? How about you guys? How about face? That okay with you guys? Give me a Y. I think, you know, we had Blake on for almost a full hour. You know, that's a little unusual. I think he covered everything. So all we would be now is redundant on our analysis here in the room. So you got the board covered. You heard Blake for an hour. You saw Steve with his finesse without charts. Celio stepped in. We know the Dixie's going to rally to 92 before it's going to 84. What else do you need? We got it all cased, right? Okay. So it's a wrap, face. Thank you very much for, you know, even for a Monday, we had great attendance today, guys. Did you notice that? A lot of people are still hungover on Monday mornings, but we had had a great turnout. And I'll see everyone for Turnaround Tuesday tomorrow. So most of all, guys, you know, Steve's calling his provider. I call on mine every day. So don't just count your pips, count your blessings. I think that what we have here in FACE is a blessing for all of us to be able to collaborate in a very tough business and to help each other succeed. So again, if you're not a member or a subscriber, risk $1. I'll refund the $1 in 10 days if you don't think it was worth $1. So, you know, 10 cents a day to check out the team, and look forward to seeing what shapes up for tomorrow. Thank you, Stel. Thank you, Steve. Thank you, Blake. And thank you, Warriors. See everyone tomorrow. Good hunting.
See you, Dale.
Thank you, Stel. Thank you, Steve. I hope you're up and good for tomorrow, Steve. I'm calling your provider for you. See you guys.
Yeah.